China's latest macro data brings a pleasant reprieve for global markets. While GDP growth of 6.4% in Q1 CY19 is a shade better than consensus, other economic data like retail sales and industrial production have fared better. Let's do a three-point analysis of what does the data indicate about economic recovery. 1. Is economic stabilization on cards? Well, Chinese industrial production grew 8.5% year-on-year in March, where a faster clip was seen across sectors like metals and chemicals, machinery, and also transport equipment. It's early to say if a credible trend of economic recovery is in the making, but it does give weight to recent IMF assessment that economic stabilization is on the cards. Recently, IMF upgraded its 2019 growth outlook for China. It expects global growth to gradually pick up in the second half of 2019. Now, some factors which had dragged Chinese growth and investment have been the regulatory measures to control debt and the supply-side reforms, leading to closure of various manufacturing units and the US-China trade war as well. However, liquidity measures announced over the last year in the form of reserve requirement ratio cuts have also been supportive. Further, there seems to be a pause in deleveraging efforts, and in fact, the economy could re-leverage in 2019. 2. What are the concerns right now? Well, it's noteworthy that China's debt to GDP ratio was 244% in 2018 with corporate leverage ratio at 154%. Now, growing credit-fueled growth makes the sustainable economic recovery questionable. While credit growth seems to be helping the real estate investment, fixed asset investment is still mediocre. Automobile and mobile sales also continue to witness degrowth. Now, this means trends for both consumption and investment are still uninspiring. 3. So what happens next? Well, one needs to watch out for the impact of recently announced fiscal stimulus of $300 billion on the economy. Now, monetary policy and also the credit measures seem to have jump-started the economy lately. However, given the leverage levels, onus is now on fiscal measures and global demand conditions. Recovery is fragile and is expected to be led by consumption. Now, financial markets seem to have dumped the possibility of a hard landing for China. Chinese equity markets have also outperformed global markets in the last 4 months. Now, going forward, trade resolution between the US and China should help restore the supply-demand imbalance for commodities. A key positive takeaway for India from the relaxation in China's supply-side reforms is that downstream industrial chemical companies in India may benefit from lower prices of key raw materials such as hydrofluoric acid, caustic soda, and phenol.